Standing here in AlUla in Saudi Arabia, after meeting with top investors and entrepreneurs, I started connecting the dots. As global investors search for risk assets at a reasonable price, many have overlooked copper's resurgence. With London prices now surpassing $9,000 per ton, the metal is back in the spotlight, driven by a rare alignment of forces that could push it even higher. The Yangshan premium over the London exchange initially climbed above zero before stabilizing at $68 per ton, signaling that Chinese demand has recovered after a turbulent 2024. This reflects growing expectations of a demand rebound in China, driven by the government's latest stimulus measures, which are providing further support to copper prices. Shanghai copper inventories have returned to minimal levels, reinforcing the bullish outlook as rising demand meets limited supply. Meanwhile, long-term supply constraints remain unresolved, with new mine approvals failing to keep pace with depletion rates of 1.52% per year. Bloomberg Intelligence estimates that without $400 billion in fresh mining investments, copper production will fall short of demand by the end of this decade, potentially pushing prices beyond $10,000 per ton. Adding to the bullish outlook, U.S. manufacturing has finally moved back into expansion territory. The ISM manufacturing PMI for January rose to 50.9, the first reading above 50 in over 2 years, signaling a promising recovery in domestic industrial production. Finally, the introduction of U.S. tariffs create a historic and unexpected price disconnect. Uncertainty over potential U.S. tariffs on copper imports has triggered a historic pricing divergence between COMEX and LME contracts. COMEX copper now trades at a premium of over $600 per ton. This is probably the main short-term catalyst of this new rally. Industry executives I've spoken to maintain a $12,000 per ton target over the next 12 months, citing strong demand fundamentals and tightening supply dynamics. In the context of portfolio allocation, an interesting dynamic is re-emerging. The copper treasury correlation has a role as a hedge for bond portfolios. Historically, copper prices have shown a strong correlation with the 5-year U.S. Treasury yield, and this relationship now appears to be re-establishing. As yields rise, copper, being a cyclical asset, could offer investors a natural hedge. In conclusion, copper, like all commodities, is typically a highly volatile component of a portfolio. However, the alignment of these 7 powerful forces, from tight supply constraints to rising demand and macroeconomic shifts, is a rare occurrence. Such convergence doesn't happen often, making this an inflection point worth monitoring for investors navigating the commodity cycle. Thank you for watching. Don't forget to subscribe to stay updated on the next insights.